Something big is brewing in the bond market, and almost no one's paying attention. Bank of America's Michael Hartnett just sounded the alarm. Trump's massive spending bill could trigger a tidal wave of bond issuance right as yields push toward multi-decade highs. Japan, the UK, the US, they're all flashing the same signal. So the question is, what happens when the bond market finally snaps? Let's dive into it. Let's start the macro outlook by diving in to a really interesting article I read over the weekend from a note from Michael Hartnett from the Bank of America. And one of the interesting things he's talking about this big, beautiful bill coming in from the Republican Party that is talking about record spending levels. And this is going to require a very large amount of bond issuance. And the interesting thing that will be is will we see the bond markets hold up during this issuance? Now, the interesting observation that he made was that that Trump can't cut spending, he can't cut defense, he can't cut the debt, he can't make the tariffs too big, and the only way to pay for this big beautiful bill is going to be one beautiful big bubble. At least was the saying. So the interesting thing to watch here is when do the stock markets start to care? And his point here is that it could very well be when we see the 30-year bonds react. And so I want to start off today's charts by looking specifically at long duration bonds and the ones he was looking at. I want to start off here by looking at a weekly chart of the 30-year U.S. government bond yield, which is trading around 5%. You can see its decade highs are all along this 5-10 area. If we have yields break out to multi-decade highs, this is something the market will react at. This is at a time when you look at what yields are doing out in England. You can see the 30-year yield there hovering right around the 550 level, also at a record high. And look at the way that the Japanese bond markets are behaving. You see yields pressing back to 320 on the upside, about to break again a decade high. At what point will the bond vigilantes say this is too much, and we have some sort of a bond event that could actually cause a disruption in the stock markets? And you can see that we're at critical levels on all of these bonds. So this is 100% the thing to watch, because here we have the S&P 500 trading at a fresh new all-time high after having an epic 3+ month run. We're now finally settling into the middle of July. We have the option expiration coming up, the first wave of bank earnings coming up. The earnings are going to be really important. Everyone's expecting them to come in as strong. And the question is that are we going to see an impact on corporate earnings from, let's say, tariff uncertainty and other things that may cause these numbers to come in as softer than everyone is expecting? Now, technically, the S&P 500 has been heavy all week. You can more or less see that all of these highs held all week long. The question is, are we finally going to see the much needed small market correction? Often in the week of options expiration, there's a lot more what's known as gamma pinning, which is that the huge option open interest causes dealers to actually be sellers into strength and buyers into weakness, causing the market to have more of a muted week, which is less volatility. Will that prevail this week? It could go in line with the idea that the market is so overbought. We're still 265 S&P points above the 50-day moving average, a very extended amount. And so the chance here that the market just pauses and consolidates throughout the week is entirely on the table. That doesn't have to be interpreted bearishly. Just after every market rise, there are often these small corrections and pauses that reset the overbought state of the market before they resume in a bullish manner. I still think that more bearish price action is needed in the stock market in order to turn in any way negative on this prevailing bull trend that remains to be quite dominant. If we did have a market correction, where could it go? You just take a Fibonacci of the prior rise. You can observe that all of the major highs of the stock market through January and December line up with what is about a 50% retracement of the of this recent advance. That in line with a technical term, that is that previous highs act as support during pullbacks. So here, even a 200 S&P point pullback back toward its 50-day moving average and back toward what is a support line of its previous highs would be just an incredibly natural pause in the markets that would probably be a buy on dip to send the markets right back up to their highs going in a little later in July. So the next thing I want to touch on is the dollar. The dollar has been crawling higher for about a week, but we haven't been able to beat even the most basic technical hurdle. Like, for instance, the Fibonacci of the previous decline over here has this 98 level act as a key target on the upside, and when you line that up with what were all of these previous supports, you can see that we haven't been able to even beat a basic resistance level for the market. So that, to me, by no means do I want to say anything bullish about the dollar until the dollar starts to actually behave bullishly. And so at this stage, I would consider it vulnerable for rejection at these levels. Will the CPI numbers or something like that be the catalyst for this? We're going to find out. One way or another, if we fail below this 50-day moving average, there is nothing stopping this from having another full leg down and testing the 95 to 96 level, which was a bigger target zone that we had earlier in the year. So the dollar is definitely underway. I want to briefly touch on the Bitcoin breakout. It's now cleared 120,000. We've been talking about in these webinars that a break of this sideways consolidation pattern had upside targets up to 120 to 130, and now we've already cleared 120. We're at 121 on the upside. There is still more bullishness to come. The question is that does it have a midpoint consolidation before doing so? One way or another, Bitcoin big bull breakout 130 to 135 is a reasonable upside target zone, and if we do have small retracements down to like 115, they are just going to be buy on dips for continuation patterns, which is always my favorite kind of entry points rather than buying the rips. Moving on, though, let's talk about gold. Now, gold was at a very critical level just late last week. We did a video on it, and it held. The 50 days held. It's trying to break out. Will they be able to clear 3,400? I want everyone to remember this number, because if 3,400 is cleared, it really does open the window for the bull continuation pattern to play out. But it does need to clear it. Like, I've been talking with members about this 33 to 3,400 area to be considered a neutral zone, to use a hockey analogy, and that you want to more or less not make any big assumptions about trends when it's in this neutral zone. I'm still looking for the bullish follow through above 3,400 to really confirm that move to 36 and 3,700 is underway. A failure here could still leave it in this corrective pattern and in the dead zone for months to come, or at least weeks to come. The next thing I want to touch on, though, is that beautiful breakout in silver. Silver didn't waste any time, not waiting for gold to catch up. This bullish ascending triangle has now set the window open for the move to finish to this $40 to $41 area. Kind of late to be playing the swing trade, but those that have been long silver, definitely you're looking for another $1 to $2 upside before we start seeing where the resistance levels really start to show there. I want to talk crude oil. Now, our thesis has been that the new trade range for crude oil is going to be in the kind of like $66 to $76 range. Very much the high volume node consolidation areas that were established established in the prior period before the April breakdown. And so here, without being super bullish and somehow anticipating, let's say, a rip to 90 or 100, I just think that the new trade range will prevail, and us trading up into the mid 70s before finding some resistance is definitely the path of least resistance. This has really started to bring attention to many energy stocks, and so we're going to be watching how these energy stocks start to turn up from here, and whether or not these are sustainable new bull trends. Talking some other commodities, copper had this epic breakout on that tariff announcement, but the move is pretty much over. And to be honest, there's almost no asymmetry in actually chasing the commodity. Now, copper stocks may be marching to the beat of their own drum, so this is more of a call on the commodity itself. But I would consider this to be a very neutral position, which is, sure, this thing could rip to 6, but all you need is one counter announcement from the Trump administration, and this thing could be back at $5 just as easily. Point is I don't see any big advantage in a brand new position up here in copper. In fact, I've been lightening up on positioning in this on that move. The other thing I wanted to just touch on, uranium had a pretty significant pullback, the U308 down to $72. But this, in my mind, is still all of the characteristics of a typical retracement. This is about a 38% retracement to the 50-day moving average of its entire bull run. And even if you just take a fib of its last advance off of the May low, you can observe here that we're at the 61.8 retracement of that area. This has been a pullback, a little bit of a shakeout of all the weak hands, but I don't see any reason to not to become bearish. To me, this is still a buy on dip, and this is the type of dips that you always have the amazing reset of the asymmetry. Now, we talked about the long bonds. I want to now move on and touch on the SOFR futures. Now, this is going to also, I think, have a move on the inflation numbers this week. So far, though, it's consolidating at the 50-day moving average above its fib zones, and we have an inflation number that is going to potentially spur a reaction on Tuesday and Wednesday. I still remain bullishly biased to this, anticipating that the long bonds, the short-dated interest rates are going to actually head lower, and the Fed path will start to reflect that. At this moment, this to me remains a buy on dip in these areas. The last thing I want to touch on, the Euro stock had a very big breakout in the indices and giving a little bit back this morning. Is this the beginning of a new bull breakout in European stocks? Well, to me, the pullback of the last two trading sessions is everything we need to watch, because if it gets bought on dip, stays above its 50-day moving averages, and we see them work it back to 5,500 in the next few days, I think it's going to be a tell that this thing is going to give a shot at breaking out to a fresh new 52-week high, clearing all of those previous highs. I want to see this buy on dip really come in here and start working. That's your macro outlook for Monday, July 14th. Have a good trading day, everyone.